and welcome to this episode. Today we're talking about navigating interest rates, particularly higher interest rates. Around the world today, there's been an explosion really in inflation, and that's caused central banks to step in and to start raising interest rates around the world. So I guess the first issue to deal with is why are rates rising? Well, what's happened in the last couple of months has been huge increases in inflation at a rapid rate. Just to sort of explain inflation to you though, inflation is when there's an excess of demand over supply, and that excess of demand leads to higher prices. Now what we've going on in the world at the moment is not so much excess demand, but rather lack of supply. So COVID has caused all sorts of supply chain issues. You know, you had ports shut down due to lockdowns. We've now got a war going on, tragically, that's leading to higher oil and gas prices. You've got a whole range of things that are feeding through to higher prices. Now, central banks don't mind a little bit of inflation. Most of them actually want a little bit, just so that prices rise naturally over time. What they don't want is very heavy deflation, where asset prices and costs go down and down and down, because they're worried that if assets particularly go down and the debt levels remain where they are, then you're going to have this debt deflation spiral, which is very, it can lead to basically depression. So they all like a little bit of inflation, but of course then they get nervous if it gets too much and inflation gets higher and higher. So they really hope for inflation around 2 to 3%. But of course what's actually happening is it's much higher. In the US it's around 8.5%, in Europe very similar sort of figures as well, and in Australia where I'm from it's around 5%. So the reaction to this is central banks are raising rates. Now this is already having a big effect. It's having a huge effect on people's confidence. You know, people are nervous about the economy because all of a sudden when rates are going up, the cost of their debts rise, particularly mortgage debt, unless they're on fixed loans. And so as a result, it starts to bite and it slows things down, which is of course partly the intent. They want to slow the economy down so they can bring inflation under control. But here's the problem. The problem is there's so much debt now in the Western world. If they raise rates too much or too quickly, then they could cause a very severe recession, even depression, because the debt levels are just so high. So they're running a very fine tightrope as to how they're going to deal with this going forward. It is going to be a real challenge for central banks around the world. What I want to talk about now is though, what's the impact on owners? We'll also talk about property owners, that is. We also want to talk about the impact on investors and what you can do about it. So obviously for homeowners, depending on the type of loan you've got, if you've got a variable type loan, interest rates now are starting to creep up. Many banks, of course, are putting their fixed rates up as well. So if you want to take out a fixed rate loan, you're going to pay a lot more than what you did 6 to 12 months ago. And that means it comes out of your cash flow. It means you've got less money to spend on other things. And of course, if you're already running a tight budget already, all of a sudden it just got really, really tight, to the extent that some people may find themselves in deficit and therefore getting themselves into financial trouble. For investors, it's a bit different. It depends on what you're actually invested in. If you've got an investment property, obviously it's the same as being a homeowner. The cash flow on the property, it's been rented out for a certain amount of money, but of course the interest rates are now pushing your mortgage up. So it has a negative effect. It also has a negative effect on potentially the price of houses, because at the end of the day, if interest rates are rising, when people go and take home loans out, the serviceability has declined because they can't borrow as much money anymore. And therefore house prices either go stagnant or even fall. And so that's starting to happen now across the world. So that can affect investors. For stock investors, it's a bit different. Higher interest rates can often be a sign of a strong economy. They want to slow it down through higher rates, and therefore the stock market may still do okay. In this case, it's a bit different because it's more about inflation, and inflation being, in this case, starting to get really high and out of control. Higher interest rates are likely to have a negative impact on the stock market in this case, because it'll affect all sorts of things, such as the cost of companies servicing their debt. It's obviously going to affect consumers, because consumers are going to consume less, and therefore profits will fall. So profits of companies, when they fall, the stock price generally falls down with it as well. So it all comes down to the particular circumstances at the time that are affecting the interest rates. So there's some of the negative things. Now, if you're a homeowner and you're watching this, you think, well, how do I protect myself? Well, first thing you need to do is do a budget and work out what is your financial position here? What is your surplus? Hopefully you've got some money left over at the end of each month. Now if you have a surplus, which is critical when you do a budget, you can throw some of that surplus against your home loan and get your debt down. So as rates rise, you've already paid down as much of the debt as you can, and therefore it has less of an impact. Another thing you might be able to do is refinance your home loan. Try and search around, maybe get a mortgage broker and get the cheapest possible rate you can get, because that will make a huge difference in trying to reduce the negative impact that higher rates are having on your cash flow. So that's a critical one to consider. The other thing of course you can do, if you find yourself in a really tight position, it may well be that you have to consider selling, and selling probably sooner rather than later, because at the moment most house prices around the world are still elevated. What you don't want to be doing is selling when things get really tough and prices fall. So just think very carefully and be prayerful and prayerfully consider what God will want you to do. But the key thing here is to be very intentional about dealing with the debt. You know, the Bible warns us that debt can lead to slavery, and of course what's happening as rising rates occur, that affects people's cash flow and they become enslaved. Okay, that's the exact thing that the Bible warns against. And so God does not want you enslaved. The devil does, because then you can't give as much, you can't be generous if you're enslaved. And so just think really carefully about the impact that this is having. And for investors, this is a bit different. I think now's a great opportunity just to wait it out, just to see how things play out. I think realistically we're in for a period of heightened volatility. Asset prices are likely to fall. They've been so expensive for so long, both shares and real estate. So more than likely there are going to be opportunities coming up. Now when is hard to predict, because you never know how markets, how much they're going to fall and so forth. But what I want to suggest to you is that see this as an opportunity, good chance to be cashed up and ready to buy good quality assets. Ultimately, investing is about buying well, okay? So you want to not pay too much for things. So as rates rise and cause the economy to slow down and, you know, things get weaker and some people are forced to sell their properties, etc., or their share portfolios because they need liquidity, whatever's driving it. Ultimately, you'll find that this will lead to opportunities. Now, we don't want to see people suffer, right? That is not what I'm saying here. Merely to say that simply when tough times come, opportunities arise. And that's how we should be thinking about it. We shouldn't be being fearful about these circumstances. So people often ask me, okay, Alex, where's this all heading? Well, I think there's probably two main scenarios that I could see playing out. The first one here is that inflation remains high for a while. We go into kind of a period of stagflation where you have low growth, high inflation, and therefore rates keep rising to try and get it under control. That's a reasonable probability. However, the other potential risk is that central banks overdo the rate rises. The rates go up too much, and therefore, as a result, they're then forced to bring them back down again quickly to try and cushion all the falls. Because what they don't want is massive house price falls and everything, because that has a negative wealth effect and slows the economy even more. So as I say, they've been running a tightrope that they're walking down at the moment. So anyway, I hope that's been helpful and give you a bit of insight on how we can navigate through some of the challenges that are going on in the real world at the moment.